Hi, and welcome to Financial Solutions. I'm your host, Mark Rigney. For those of you attempting to prevent a foreclosure or have your mortgage loan modified, you'll want to pay close attention. On today's program, we have a mortgage modification and RESPA attorney in our studio. Her name is Karen Kennedy from Karen Kennedy Associates. Karen has over 31 years experience as a practicing attorney and specializes in civil litigation. Our show today will focus on helping homeowners to prevent foreclosures and negotiate beneficial mortgage modifications with their lenders. Karen tries open cases within the federal system against mortgage lenders alleging violations of the Truth in Lending Act and the Real Estate and Settlement Procedures Act. While the cases are still in litigation, she has successfully obtained restraining orders against banks seeking to foreclose on her clients' houses. In the wake of the financial meltdown, she decided to apply her negotiating skills in the service of people in danger of losing their homes to foreclosure. Hi, Karen. Thanks for being here today. We're excited to have you.
Thank you, Mark.
Karen, let's start from the beginning. Why don't you define for us exactly what the mortgage crisis is all about?
Well, what happened is in 2004, 2005, during Clinton's administration, they removed what was before like a stone wall between mortgages and securities.
Okay.
They removed that wall, and all of a sudden, mortgages could be securitized and sold as bonds or shares.
What does securitized mean? Explain that for us exactly.
Securitization is the process where you have an originating lender.
Okay.
That lender then bundles a bunch of loans together, names it as, for example, Countrywide Mortgage-Backed Securities, 2007-AR, and then sort of peddles that package,
that pool of loans
on Wall Street.
Okay.
Wall Street goes to various investors, and it can be private individuals, but normally it's institutional investors.
Okay.
It's pension funds, 401ks, other kind of packages that are out there in the market.
Okay.
And so what they do is they sell this particular package of loans to investors. They create a trust, and they name the trust, and they stick these loans in there.
That's what securitization is.
That's securitization.
Okay, okay. So how did all this crisis begin then?
Well, what happened was that there was a go-go, let's free money, essentially.
Okay.
Everybody was borrowing money, and the lenders were very anxious to give it to them. They came up with a lot of these strange packages, these 5-year ARMs. So people got into them, and they thought, okay, this is what my mortgage payment's going to be. And what they were told by the brokers is, don't worry about it. Yes, your loan is going to go up 3 percentage points. In other words, your interest is going to rise from 5% to 7.5%. Don't worry about it, because when you get there, your home will just go up in value and you'll be able to refinance. What happened is everybody's loans started readjusting. They weren't prepared for the payments, and they started defaulting because they couldn't refinance, and it just became a cascading waterfall.
Okay, so one problem led to another, and the interest rates rise. Now they can't refinance out of these programs they're in.
Yes.
Okay, are there any specific types of mortgages that are more to blame for this than others?
I put a lot of blame on what you call the adjustable rate mortgages.
Okay.
And even worse culprit is the negative amortization mortgages.
Now, explain negative amortization for our borrowers.
What negative amortization is that you have an interest rate that's on your note. You're supposed to be paying 5%. But they look at your financial ability to pay, and they say, okay, for the first 5 years, you don't even have to pay the entire amount of interest on your loan. You pay this payment, and we'll just add what you're not paying in interest to your principal.
So after a while, your loan balance actually goes up.
It goes up.
It doesn't go down or stay the same. It actually goes up. So you're not even meeting the initial terms of the loan, correct?
That's correct.
Okay. Well, that's pretty rough stuff there.
Yeah. I mean, you see, particularly borrowers that have invested in new subdivisions, and they were sold these loans. And they think, okay, well, it's a new property. It's going to go up in value. My job is going to be better. It was also...
So those are the reasons why they would take a Neg AM loan, is that correct?
That's correct.
Karen, how does the pooling and servicing agreements play a role in all of this?
The pooling and servicing agreements are the documents that control the securitized bundle of notes.
Okay.
They have the terms of which all the investors that invested in this pool, how they're going to get paid, when they're going to get paid, what tranche they are in.
Okay.
A lot of people don't realize that they actually divided these notes into tranche A, tranche B, tranche C, tranche D. And it goes from good borrowers down to the worst borrowers in tranche D. As tranche D borrowers stop paying, then always tranche A gets paid first. So you actually could be making a mortgage payment and it would be going to a different level of investors.
Really?
Yes, the money's not even going to your note if you're down in tranche B or tranche A.
Okay.
They call it the waterfall.
Okay.
So the pooling and servicing agreement controls the flow of money.
Okay.
And it actually is controlled by three big trustees, normally, and they are the Bank of New York Mellon, Wells Fargo, and Deutsche Bank.
Okay. Explain for our viewers here what a credit default swap is and why does it matter?
It's one of the most insidious things that happened in this entire situation.
It's a major role player for the whole crisis?
Well, it is because it gave a false sense of security to all of the investors.
Okay.
A credit default swap is basically you buy insurance on the gamble that this security, the payment on the note, is going to fail.
Wow. Okay.
And if the note fails, or in some cases, depending on the policy, even if they feel that the security for the note, which is the mortgage on the property, and the property has gone down, they can claim the credit default swap insurance.
Okay.
So, and
who's they when you said they can claim?
Well, you know that most of the brokers, the stockbrokers that sold these products to all these investors, they bought credit default swap insurance themselves.
Okay.
So that they are getting paid on bad loans that they sold to the investors.
Okay.
Some of the investors also bought credit default swap insurance. So you could actually have a situation where a borrower is getting foreclosed on, but his loan has already been paid in full to the trust from the credit default swap insurance.
Who provides the credit default? Is it the federal government?
No, it's on Wall Street. It was private insurance companies.
Private insurance companies.
The biggest of which was AIG.
Ah, why does that name sound familiar?
Yes.
Yeah, they had part of the bailout, correct?
Exactly.
Yeah.
AIG bought into this credit default swap insurance in a big way.
So ultimately, the government has to pony up the money to bail AIG out because they were doing the credit default swap. Okay, well that makes a lot of sense. Explain to us what a loss share agreement is and what role does it play?
Well, two of the biggest originators of loans were Countrywide Bank and IndyMac Bank.
Okay.
Again, when the people were not able to pay their debts, they were not able to get new money because there were no more new trusts being formed because they started to see that people were defaulting on these loans. So they weren't able to meet their obligations. So FDIC came in and took over these failed banks. Two of the biggest are IndyMac and Countrywide, as I said, but there's a list of about 50.
Wow.
And what they did is the FDIC actually peddled these loans that IndyMac and Countrywide had formed in these trusts to other investors. And you have Wells Fargo, Bank of America, Chase. They bought the majority of this paper. But to get it sold, the FDIC had to say to them, if you buy this paper and you take a loss on it, we will pay you up to 80% of any loss that you sustain.
Okay, so it's insured in some ways then.
Right.
Let's get down to the grassroots of the interview here. Why is a lender in such a rush to foreclose instead of giving the borrower a chance to get back on their feet, if you will? Why are they in such a rush to get that foreclosure done?
Well, we touched on it before, Mark, and the reality is that the lender makes more money foreclosing on a borrower than ever they do modifying the loan.
Is that right?
You have to think about it. Okay, I'm going to modify your loan.
Okay.
I'm going to get paid over 30 years. Sometimes they've had to extend the loan to make the payments work 40 years. So the investors are not going to realize any money in any quick way.
Okay.
But if they foreclose,
Right.
first they say this loan failed, so I want to get a payment on my credit default swap.
So they get their insurance money in.
Secondly, they say to the feds, I have taken a loss, pay me 80% of my loss.
Oh my gosh.
Third, they foreclose and get the money from the sale.
So they actually sell the home and get insurance from it at the same time.
And get the FDIC to pay them 80% of any loss they say they have sustained.
Wow, that's scary. That's scary. Do you think that some banks are doing that deliberately, like delaying the loan modifications so they could hurry up the foreclosure process? I know it's a rough question for you to answer here on TV, but how do you feel about that? Are there some banks out there doing that, or are they all legitimate? They say, you know, I lost your documents, resend the documents. Meanwhile, they get a letter in the mail saying we're foreclosing on your house. Is that legitimate? What's your opinion on that?
My opinion is that the banks and their servicers, what you have to realize is when you get your mortgage statement, you're not getting it from the investor in your loan, which is usually the securitized trust. You're getting it from an entity that they have hired to manage sending you the bill, collecting the bill. And they're called servicers.
Okay.
All right.
Okay.
And so the servicers are overwhelmed, to be honest with you.
Okay.
That's one problem.
Overwhelmed with mortgage modifications?
Yes.
Okay.
That's one problem. They lose the documents. We found this out early on when we started to do this work.
Okay.
They lose the documents because they get so many documents mailed to them that their mail rooms are stacked almost to the ceiling with packages. So what we learned to do is we find the fax number. We get them to tell us the fax number of what goes directly into that modification department, and you fax the documents. Then when our borrower gets a letter saying, well, we've lost your documents, we call them up and we say, okay, we faxed this to you on such and such a date at such and such a time and got a confirmation. But you asked me a really tough question.
I know, I did. Hope I didn't put you on the spot there.
No, I'm going to answer it.
Okay.
I'm going to give you it's not empirical data, it's my feeling from doing this for 2.5 years.
Okay.
What I think is that the banks want to wear you down.
Okay.
They give lip service to modifying, but they want to wear you down to the point where either you're so far behind, if they do say, no, we're not going to do it, and you owe us all this money back, that no borrower can do it, or that you'll just give up and go away.
So in that case, what would you recommend to our viewers here facing a situation like that? Just be vigilant, just hang in there, keep fighting, keep chugging away. I mean, the worst thing they could do is